And welcome to another Lumi Financial Corner. With us once again, Michael Zaremsky, head of U.S. Private Banking, Bank Leumi USA, member of the Investment Committee for Leumi Investment Services. Michael, good to have you back. How are you?
Doing great, Zev. It's good to be back. Thank you. Hope you had a nice Thanksgiving.
Had nice Thanksgiving, nice Hanukkah. Thank you. But people were worried. The markets, there was a lot of tumult that really went down and going up. What's going on? Because it seems to be some static.
Zev, it's a great question. And again, just let me remind everybody that the views expressed are my views, not necessarily those of the bank or the broker-dealer. And when we spoke about 2 weeks ago, right before Thanksgiving, everything was rather calm in the market. And as I've always kind of stated, there's three key pillars that are really driving the investment world. One of them is COVID, which 2 weeks ago seemed to be well in check. One is fiscal policy, one is monetary policy. We obviously had a big scare in the marketplace regarding the Omicron variant, which came out of South Africa. And as you know, again, the market got very concerned about that as we headed into some of the thin trading around Thanksgiving time. Certainly risk was off the table. And as more and more reports have come through that maybe Omicron isn't going to be such a dangerous variant, reports are that it probably is very highly contagious, but not that severe in its impact. You've seen the markets respond rather quickly, which again, I think is just a testament to the way that we look at the three key investment legs. And as soon as the COVID issues have kind of gone away a little bit or dissipated, you can see how quickly the market has rebounded in the last few days. And if you went to sleep 2 weeks ago and woke up today, markets are kind of back at a lot of the same levels they were at. And you basically would have round tripped everything because of the concern, kind of risk off due to the COVID. And then again, the risk back on as the COVID issue has dissipated.
No, makes sense because people are concerned there'll be shutdowns and lockdowns, in which case the economy takes a downturn. So they're nervous when that happens, and now it's back to normal, so to speak. Or is it back to normal because inflation is high? I know people talking about it constantly, and the president has said, and the White House has said that, well, things are going to change now because oil prices are going to drop, other consumer items are going to drop. So what's the story? How does that affect the markets? And are we really seeing a drop? Because I saw other reports saying inflation can be with us at this level for a year or more.
So again, Zev, I think that's a very poignant question as we head into the new year. And I'll go back to the key drivers that we have. When we look at monetary policy right now, clearly the Fed is reacting to some of the pricing issues that we see. So whether it's true inflation or whether it's just a step-up increase in prices, clearly the market is reacting to significant demand from consumers for services, for everything, and the amount of money that's really flooded the market with all the stimulus that we've seen. So to some degree, I think that we can pretty clearly say a lot of these elements will continue to be with us. However, we are seeing the Fed react pretty meaningfully. A lot of the rumors and the expectations right now are that, based on the last presentation from Fed Chair Powell, there's a high likelihood, and the market is anticipating that we will increase the speed of normalization. So again, the speed of tapering will increase, meaning that instead of being through with the quantitative easing program in June, people think it may accelerate to the Fed ending its buying of corporate and treasuries and all other sorts of bonds in March. And if that happens, the expectation is that we may see the beginning of a rate hiking cycle start earlier than anticipated. So earlier this year, the expectation was that we wouldn't see rate hikes until 2023. That generally started moving up earlier into maybe the fourth quarter of 2022. And now the expectation is that we may see 2 or 3 rate hikes, which might possibly start as early as June. So the answer to your question is that when the economy heats up quite a bit and you start to get some of these inflation fears, the tool that's out there to govern that is monetary policy. And the Fed seems to be very aware of that, and they're trying to rein in and control that risk. So ultimately, what I think we're seeing is that we're getting much more back to normalization across everything. And that leads me to, I think, a very important point for everybody as we close out the year and start looking ahead to 2022. We've been in an environment for about 2 years now, which has really been driven by COVID, by the lockdowns, by the recession, and by all things having to do with, from February, March 2020 to today. As we continue to move more towards normalization, I think it's a really good time, particularly at the end of the year, to kind of take inventory. And as I like to say, every now and then it's good to kind of take a look at the garage and clean out the garbage. And at this point in time, I think we need to look around and say, well, what worked in 2020? What worked in 2021? Why did we buy certain things? Why do we own certain asset classes? And then the question becomes, are these the appropriate tools that we want to have in our toolbox going forward for kind of the normalization of economic activity that's expected in 2022 and beyond? So again, for a lot of people who are very concerned about inflation, the worst fears of inflation seem to be subsiding. Is it time to rethink some of the inflation portfolio? Because the Fed seems to be, if you were a believer that the Fed was behind the curve, the Fed seems to be getting back up to speed on where they need to be. Again, if you were concerned about runaway fiscal spending, again, that's kind of been tucked back into the closet a little bit, as a lot of debate is continuing to happen in Congress about Build Back Better and how much more spending the economy can really tolerate. So as we move forward, I think that it's a really good time to think about, what does recovery mean? Have we recovered? What does inflation really mean? Where are pockets of inflation? What's investable? How do you want to slant your portfolios towards growth, income, safety? And again, I think that right now at the end of the year, it's a good time for everybody to take stock, look back through. And again, it's almost like an exercise of cleaning out the basement or cleaning out the garage and making sure that you're prepared for the new year ahead.
Michael Zaremsky, head of U.S. Private Banking, Bank Leumi USA, member of the Investment Committee for Leumi Investment Services. Thank you for being here with us.
Thank you very much, Zev, and look forward to speaking in a couple weeks.
Looking forward to that, and we're going to be right back.